what would an IUL look like for a young entrepreneur? Today, we're going to take a deep dive into a hypothetical situation where an entrepreneur is putting away for 20 years, $50,000 a year, and frequently pulling money out to fund his business ventures. You could change that number if you wanted to. It's just round one. Let's get into it. Two little disclaimers here. One, if you're not a numbers person, you don't really like diving into the details and the spreadsheets and all of that. I do have tons of videos that just go over the nuances of IUL, why you might consider it to other vehicles, etc. Here's a very simple one for an initial understanding right here. Feel free to click that if that's the case. If you're not, you're someone who's an engineer, wants to see all the numbers, you're in the right spot. And secondly, just gonna read this, but this is only a hypothetical, does not represent any insurance company or actual IUL product. It's intended to be for educational use only. Of course, you have to actually consult someone if you want to see an illustration for you from an official insurance company. Let's do it. Okay, in this example, we're gonna start on this illustration here, and then I'm gonna switch over to a spreadsheet where I'm actually able to put in different loans for different years so we can play around with it for a bit. First thing you're gonna see here is your premium column. That's how much you're putting in. Your policy loan, that's how much you've loaned out. Your loan balance, that's the sum of the loans you've taken out and the interest that they've gained. So in this case, we're gonna have them assuming they're gaining an interest of 6%. So if you take out a loan, we're gonna assume that it's going to accrue at a 6% interest, but that same money is gonna stay in the policy, gaining 7. We have our accumulation value. That's how much money is actually linked to the index. And in this case, we're assuming a 7% return. Surrender value, that's how much you actually have access to. The death benefit, if you were to pass away, that's what's gonna be transferred to our heirs tax-free. Now, what I wanna do next is actually get into looking at what would happen when we start taking some loans. So let's zoom in here, and let's say you're putting in the $50,000 a year. So I started this if you were 25 years old. I have 26 on the left there. That's how old you would be after the first policy year. Now, the thing for entrepreneurs, and I've made another video similar to this, is we want to put away money. We want to be able to save money where it's growing, it's compounding. If something happened, we could access it. Or if another business opportunity arises, we could pounce on it. The problem is we're entrepreneurs. We need access to our money. We move quickly with our money. It's not necessarily practical. So what the IUL allows an entrepreneur to do is not only just put away money and forget it, but be active with it. So in this case, let's go back to the screen. Yes, we're putting in $50,000 a year, but if you wanted to pull out $25,000 a year, you could. If you wanted to, in this case, let's say they funded $50,000 for the first 3 years. So let's say you had to put the $50,000 in for 3 years, and at that point you said, all right, I want to access $100,000. So if you did that, you took a policy loan. Well, what you see is that the surrender value then drops by $100,000. A little more, actually 106. Why? Because it's gaining 6%. Our loan balance went from 100 to 106,000 by the end of that year. Now, one key thing here is I have the surrender value equaling the accumulation value right away, which usually it's not actually going to be that. As we saw in the other example, usually that surrender value is going to be less, especially in those beginning years. Eventually, it will catch up to the accumulation value though. Again, just for example's sake, it was easier on the software that I made. Now, if you took that out to go put it in an investment, invest in yourself, and maybe you bought some training, whatever it might have been, and that starts to work out, then maybe you start to pay it back. You don't have to, but if you did start to pay it back, you could start to do that. So let's say over the next couple of years, you did $50,000 a year for those next 2. You capped it off with the 99,2160, that's the remaining balance, paid it off, and now you had that money working for you the whole time. So even while you took it out and you went and invested in yourself for a business venture, you were able to still have that money working for you, and you had all that room to pay it back. Now I'll go through a couple more iterations of kind of what it looks like if you're taking policy loans and paying it back. But as we know, being entrepreneurs, there is going to be times where maybe we take out money to put it into some sort of investment or to invest in ourselves, and it doesn't necessarily work out. And I want to look at that now. So let's say you just went until you were age 33. You've got this $473,000 accumulation and surrender value, and you say, I'm going to take a risk on this business or a bet. I'm going to pull out $250,000. So you pull out that money, right? The accumulation value stays the same. Why? Because that is not affected by our policy loans. Now our policy loan value is going to increase. That's going to increase by 6, but that 250 that we pulled out is going to continue to increase by 7%. Again, that's just in this example. But if you never paid that loan back, say it never, it didn't work out, unfortunately, you didn't get a great return on that, you continued to put the $50,000 in a year from other ventures or whatever, you just couldn't pay that actual loan back. If we scrolled all the way down, just hypothetically, to age 62, we can see in this case we have a loan balance of $1.435 million. Now, a lot of people might say that, say, geez, that's a big loan balance. I'm not really sure I'm comfortable with that. We do still have the accumulation value of $6.07 million. And if that's the case, well, we have 6.07 growing at 7% and the 1.43 growing at 6%. That shows us we still have a surrender value here of the $4.6 million. So even though in this specific case, we pulled out the $250, could never pay it back, we've let that grow to a pretty big loan balance, we still have that full $6 million working for us and therefore leaving us with a surrender value of the accumulation value minus the loan balance, in this case, the 4.64. So this is a very simple example of kind of how an IUL could work for a young entrepreneur. You have that annual amount, you're funding it. If you needed to stop funding it at some point, you could do that. If you need to access the money, you could loan money out, you could use it for a venture, you could pay the loan back. You don't have to pay it back in all cases, but the main thing is you put money in, it's working for you, and then when you pull it out and you go put it into a venture, it's still working for you. Being an entrepreneur myself, I know how crucial this can be just because so many times we get stuck in this keeping money in a bank, keeping it getting 1%, or even keeping it in a high yield savings and just being stuck in this loop of, I need to keep this cash on hand in case something comes up. Well, this gives you the opportunity to do exactly that. Feel free to comment below, leaving a message on what you might want to see. If you did find this helpful, be sure to subscribe. That's all this channel is about. See you in the next one.